What's up, real estate investors? Today we're going to be going through the top 3 strategies that high income earners use to reduce their taxes by up to 5 to 6 figures in taxes when investing in real estate. The first one is going to be they play the passive loss game. The second one is going to be qualifying for the real estate professional status, also known as REPS. And the third one is going to be using the short-term rental loophole. Hi, my name is Thomas Castelli, and I'm a CPA and tax strategist who's helped hundreds of investors just like you reduce their taxes by millions of dollars using the strategies we're about to dive into right now. The first one is going to be playing the passive loss game. So when you buy a piece of rental real estate, whether directly, so you just go out and you buy it yourself, or you invest in a syndicate or fund that invests in rental real estate, you're going to have the non-cash expense called depreciation, which can put you at a loss for tax purposes. So in other words, you're telling the IRS you lost money despite the fact that you might be putting positive cash flow into your pocket. And here's how this helps high income earners reduce their taxes. Let's just say you're a high income earner who's making $700,000 per year. If you're making $700,000 per year, you're going to be paying roughly $214,000 in taxes. So we're going to see how that impacts your effective tax rate. So your effective tax rate is the amount of taxes you are paying relative to the amount of income that you're generating. So in this example, you're paying roughly $214,000 in taxes, and you made $700,000, presumably in W-2 or active business income. So let's go ahead and find out what your effective tax rate is. So your effective tax rate, again, is the amount of tax you're paying divided by the amount of income you're generating. So in this example, your effective tax rate is going to be 30.6%. But now let's just say you're able to generate $100,000 in rental income that's sheltered by depreciation. So in other words, you're not paying tax on this rental income, but you're still paying tax on your $700,000 of W-2 or business income, right? So in this case, we're going to take that same $214,000 that you're paying in taxes, but in this time, we're going to divide it by $800,000. Remember, the $700,000 from your rental, your $700,000 from your W-2 income. Now we have $100,000 in tax-free rental income, right? So now you have $800,000 total. Your effective tax rate in this example is now 26.7%. So your effective tax rate is going down. Believe it or not, this is how some of the wealthiest investors reduce their taxes. They have a high income generating business or high income generating job that they are paying high taxes on, but they are taking this money and using it to invest in rental real estate, where you can generate tax-free income, okay? And then as you generate more and more tax-free income through rental real estate, you are reducing your effective tax rate, effectively reducing your taxes. So this is the first bucket. This is the game I actually play right now. I invest in real estate passively and use depreciation to shelter that rental income from tax so I don't have to pay taxes on it. But now we're going to move into the real estate professional status. So the real estate professional status, also known as REPS, allows you to use these losses that you're generating to not only offset your rental income, but also offset your W-2, business, or other non-passive income. And the way to qualify for the real estate professional status is by A, spending more than half your total working time in a real property trade or business, and B, spending more than 750 hours in a real property trade or business. Now, spending more than half your total working time in a real property trade or business can be challenging if you have a full-time W-2 job. In fact, if you have a full-time W-2 job, it's nearly impossible to qualify for the real estate professional status as proven by IRS audits and tax courts. So how can you get around this limitation, right? Say you want to take the losses from your rental real estate and use them to offset your W-2 income or your business income. How do you get around these limitations? Well, the first way is you can have your spouse qualify. If you have a high income job or high income business and you can't qualify for the real estate professional status, but your spouse can, and you file a joint return, well, then you both benefit. And we see this scenario all the time, and it can be quite powerful. But what if you and your spouse cannot qualify as a real estate professional because maybe you both have full-time jobs or own businesses that you're working in full-time? Well, in that case, you have option number 3, which is the short-term rental loophole. Now, see, under the tax code, there is a special carve-out that says that if you rent your property out for 7 days or less on average for the year, then your property is not a rental property, and instead it's a regular business. And when you have a regular business, you do not need to spend more than 750 hours or more than half your total working time to use the losses from your real estate to reduce your taxes. All you need to do is materially participate. So how do you materially participate in your short-term rental property? Or you do that by meeting one of 3 tests. The first one is you spend more than 500 hours on your short-term rental property. Now this could be a little challenging to do, especially if you only have one rental property. Now number 2 is you spend more than 100 hours on the activity and no one else spends more time than you. Or the third one, you do substantially everything for your short-term rental property. The most popular one out of these is by far this 100-hour test, because you can spend 100 hours or more of work on your short-term rental property, still delegate certain tasks to cleaners or to handymen. They come and help you repair your property while you are working from afar. So there you have it. Those are the 3 strategies that high-income earners use to reduce their taxes using real estate. Again, to recap, that is the passive loss game. You invest in rental real estate and use the non-cash expense called depreciation to shelter your rental income from tax, and over time, the more rental income you're generating that is tax-free relative to the income that you're paying taxes on from your job or business, this will reduce your effective tax rate and effectively reduce your taxes. And this is actually the strategy some of the wealthiest investors use to reduce taxes using real estate. But what if you want to take the loss that you're generating from your rental properties and use it to offset your W-2 or your active business income directly? Well, that's where the real estate professional status comes into place. If you're able to work effectively full-time in rental real estate, or your spouse is able to do that, then you can take the losses from your long-term rental properties and use it to offset your W-2 or active business income and significantly reduce your taxes, oftentimes by up to 5 to 6 figures. But you can't work full-time in real estate and still want to use the losses from rental properties to offset your W-2 or business income. You can do so with the short-term rental loophole, which does not require you to work full-time in real estate. You just have to rent your property out for an average of 7 days or less and materially participate by meeting one of the 3 tests that I mentioned. That is the 500-hour test, the 100-hour test, as long as no one else is spending more time than you, or you're doing substantially everything yourself. If you have questions about this, go ahead and drop them in the comments, and make sure to hit the subscribe button so you don't miss out on future videos on how to reduce taxes using real estate.